All right, in this lesson, we're going to be going over contingent liabilities. We're going to help you understand what is a contingent liability, and then in what instances do we report them in our book. So let's get started by helping you understand contingent liabilities. So contingent liabilities are potential liabilities that arise as a result of a past transaction. So something in the past now is coming up to fruition in which we might owe something in the future. Now, the key thing about a contingent liability is that the results of those liabilities are based on an event in the future. So we're not saying right now we owe, but when that event kind of comes to a closure, then we'll know if we're going to actually owe. But there's something in the future that is going to tell us whether or not we're going to owe or we're not going to owe. And because of that, we might need to book a liability. Now, this means that contingent liabilities produce an uncertainty rather than an absolute certainty to the debt. So if I borrow $1 million from the bank, it's certain that I'm going to have to pay back $1 million. But this contingent liability is basically telling us that we're not 100% certain if we're going to owe money at the end of the day. Now, the question then is, when do we report them in our books and when do we not report them into our books? Because we could say that we could have a liability for someone tripping on the sidewalk. Well, do we report that or do we not report that? Because anything is possible, right? So here's kind of how we would figure out if we're going to report something on our financial statement when it comes to a contingent liabilities. So the first thing you have to ask yourself is, what is the likelihood that we are going to be responsible for some type of liability? So the first case might be that we are very probable that we're going to be responsible for it. Now, if it's probable that we're going to be responsible for it, the next question that we need to ask ourselves is, can we estimate it? If we can estimate it, then we're going to need to book the liability now. So if we know how much we're out, if we know how much we're going to have to pay, then we're going to have to book that amount in our books as a liability because it is probable that we're going to owe. Now, what situations might be a situation where it will be a contingent liability and we're going to owe? Let's say we are in a lawsuit with another company. The company is suing us, and based on all the facts that's going on in the courtroom now, we believe we're going to owe some type of money, and we can pinpoint it down to maybe X amount of dollars. Maybe we can figure out what that we're going to lose, and we're going to have to owe $500,000. Because we know that information, then we're going to record the liability now. Now, if we don't know what the amount is, then we're going to disclose it on the financial statements, but we're not going to say what the amount, we're not going to book the amount into our books because we don't know what the amount is. Now, when we do disclose it, we might give a range of what that looks like, but we don't need to book it into our books, therefore reducing our net income. Now, if the likelihood is that it's reasonably possible, but we're not absolutely sure, we're still going to report them in our notes, in our disclosures, in our financial statement, regardless of if we can estimate them or not. So notice here, I don't have can we estimate it? We're just saying that if there is a reasonable possibility that we are going to owe some type of money, we're going to go ahead and just disclose that into the books. Because it's not probable, we're not going to actually report them in our books as a liability. And then the last kind of situation of the likelihood that a liability would occur is that there is a remote chance. So for instance, what is the chance of someone tripping over, let's say, the door frame when they walk into our business? Well, it's probably at a remote level, and so we're not going to accrue an expense for a possibility that someone's going to trip and then we're going to have to pay $100,000. So in that case, we don't disclose anything because we really don't have enough information to say that we're going to owe something. And for all we know, nobody's ever going to trip on the doorway into our business, and so we would never be liable for anything. So we don't want to get into the what if games of everything in life as being a contingent liabilities, but those that we are reasonably certain that we are going to owe, let's go ahead and book it if we can reasonably estimate it. If we don't know, then we're just going to put a note to the financial statement. And if there's just a reasonable possibility we're going to be on the hook for something, we're going to disclose it, but we won't report it in our books as a journal entry. And then the remotes, we don't even touch it because, again, it's a remote chance that we're going to have to owe something to someone else. So let us take a look here at an example. So assume that company A is being sued and the likelihood that they will lose the case and owe money is very probable. So we're saying that there is a high chance that they're going to owe something. The legal team believes that they will incur a judgment of $22,500 from the probable loss in the case. Prepare the journal entry if necessary for the contingent liability. So we are owing. So if we're going to owe, then we are going to need to credit a liability. So to credit a liability, we're going to have to credit some type of liability. So we're going to use, let's say, a loss payable or even a legal payable. So we're going to go credit legal payable in the amount of $22,500, and then we're going to need to debit something. So we're going to debit loss on lawsuit in the amount of $22,500. That loss would go on our financial statement, reducing our net income by $22,500, and then we would have this legal payable of $22,500. Now, again, because we're not exactly sure what's going on here, legal payable is fine, or if we can fine tune it, something payable, lawsuit payable would be fine as well. But again, we're just going to go ahead and book the expense because there is a very probable that we're going to have to owe it. So maybe the decision is about to come down and we know we're going to owe it anyways. We're going to go ahead and report that. Now, the key thing here is that we don't know what the results is until the next period. So we're at the end of the year, we're in a lawsuit, they've recessed for the holiday break, but we know we're going to owe, we know the judgment's going to not be in our favor. So we're going to go ahead and book that expense even though that lawsuit will be completed in the new year. Now, if it's completed in the same year in which you are doing the financial statements, then you're already booking that expense or that loss when you've paid that judgment. So again, just thinking about contingent liabilities and what needs to be done at the end of the year. So that is our talk here on contingent liabilities. I hope you enjoyed this lesson. We'll see you in the next video. Hey guys, if you like this video, make sure you press the like button below. And if you're looking for worksheets that go along with all of these lessons, head over to my website at patrickleemsa.com or clicking the link in the far right. And I've got your next lesson right over here. So just click that link and it'll take you to that video. So until then, we'll see you in the next lesson.